I'm a manager of time. This is a quote by Hugh Henry. In his podcast Confessions this week, he dropped this line and it made me think, what am I? Am I a manager of time? I'm not. I'm actually not a manager of time. I want to discuss this and contrast myself to Hugh Henry. This is a Not Even Wrong podcast. It's March 27, 2021. This is Krim Delco. It's a Saturday. This is the second episode today. And like in the first one, of course, there's no update. So we're still down roughly 12% for the year. And the market's up 5. We're underperforming by 17%. So Hugh Henry, in his latest podcast series, Confessions, he talks about his ideas from the past. He puts the arc to today and contrasts the past with today. I think a really interesting concept, a very, very good thing. Just to remind people, Hugh Henry was the person that actually gave me the idea to start this podcast. And I think both of us have the same, I assume, I don't know him personally, but I believe that his thinking is, if I express myself, if I express my thoughts, I will first of all get feedback, but also I will learn much better about myself and what am I actually thinking and what am I trying to do. So I think this is the fundamentally most important thing in this whole exercise here. As much as I appreciate you guys listening, and I'm very happy for that, I also think this is just therapeutic for myself, and it's also a nice record for the future to come back and think about what was I thinking on March 27, 2021, down 12%. What were my thoughts? And here is this episode is about the concept of what Hugh Henry said is, I manage time. Now, I don't know what exactly he means with that, so I'm going to conjecture what he means. I'm then going to conclude that that is actually why he behaved the way he behaved as a hedge fund manager. And then I'm going to contrast that with today. So first of all, let's talk about the behavior. Hugh Henry was, I would say, like an old school hedge fund manager, in the sense that he had a position and he every day was moving around the positions. He was a very active manager. He was using a lot of leverage also. So he had two things that we don't do. We don't trade a lot and we don't use a lot of leverage. Our leverage is about 15%. Now, vol adjusted, probably our leverage is pretty high. It's probably 200%, which just means that we have very volatile positions. So having only 15% leverage with a very volatile portfolio is probably the same like Hugh Henry having 250% leverage with very little volatility. I disagree with that, because particularly in this day and age with algo trading, with all these algorithms influencing market prices, the concept of volatility kind of loses itself. And that's why we think we're not very levered, because our leverage, or having a portfolio of treasuries, or having a portfolio of gold or whatever, it's almost the same thing, because you could have a day when gold is down 10% easily, and it could make no sense, and it could be completely out of control, and in 2 days it could be back. But on that particular day, you could have a margin call. So I think volatility and all these concepts, this is a whole new episode. I don't want to talk about this, but I just want to get back to the point. We don't use a lot of leverage. Hugh Henry used a lot of leverage, and he was trading a lot. And I think that's what he meant. He meant that I'm a manager of time, which is everything, every idea needs to be put in place at the right time, at the right place, and then close at the right time. So he was a very active trader. And I think we are not like that. We are the exact opposite. We put on, I said, our degree of freedom is just by the wealth generating company that you think is going to generate the wealth against your mission. Now let me step back a bit. Our mission is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. So once we find that company, we never sell. We just stay invested until we need the money. If we have let's say our living expenses or something like that, but you never sell because of the profit. You're an eternal shareholder of this company until the moment when, for some reason, it doesn't fit your mission anymore. The company is not generating any more wealth. There is no more new concepts. Their engineering practices don't work. Things like that. There is no such thing as competition in this context, because by definition, if the company is successfully implementing fundamental new concepts and engineering practices and follows our principle stack, which is based on the 4 books of 0 to 1, the beginning of infinity, the innovation stack, and the innovator's dilemma, if the company fits into that framework, then there's also no competition. So there's only unforced errors here. Only the company itself can make us uninvest. So having said all of that, now why isn't Hugh Henry doing that? Or why isn't there's another gentleman, I just listened an interview to a hedge fund manager who, again, he said, we are like a poker game. We constantly trade. We try to take advantage. We try to be liquidity providers. That's another word for we trade around our positions, which means we want to buy low and sell high. So we want to buy low when everybody's selling. We provide liquidity, and then when everybody's excited and the stocks are very high, we sell and provide liquidity for those who buy. So it's a passive aggressive way to say we are smarter than the market. And this is exactly the connection I want to make. I don't think I'm that smart. I don't think I can trade around. I don't have the technology to do it, nor do I have the intelligence to do it. I just don't know. The markets to me are an incredibly complex system that I don't understand. So I don't want to play the markets, trade around the markets, none of that. It took me more than a decade to understand that. We were very similar to what Hugh Henry was doing and many other people. We thought that we can get in and get out, we can short this, buy this, our narrative works today, it doesn't work tomorrow. We had all these schizophrenic, today we like it, tomorrow we don't like it. Now, I don't want to judge people. I believe this is not possible. I think people like Hugh Henry, as interesting as he is, the reason he had financial success with this strategy is I call it the tossing the coin syndrome. So he was just lucky tossing the coin several times and getting the right guess. And then at some point he was maxed out of the market. Basically, he was pushed out of the market because this strategy just doesn't work. Or at least it doesn't work in terms of wealth generation for investors. It might work for himself, generate fees, generate a nice relationship with the street. Again, I don't mean to, I have nothing against Hugh Henry. He's a very inspirational figure. Actually, I like him a lot. I'm just saying professionally, I don't think he's in the right business to try to trade around, buy this, sell that, all these things. It's not my thing. And here's why. I actually have a fundamental explanation for this. And here's why. In general, we are trying to invest in wealth-generating companies that follow, like I said, our principal stack. Part of our principal stack is the concept of the innovation stack. So you start with something and you solve a problem, you create new problems, you solve a problem. The fundamental force here is iteration. So what we're really looking for is companies that continuously iterate. We've said that before. Disruption is a direct function of the cost of iteration. If you are exposed to a new concept, let's say you have lithium-ion batteries, or you have a new way to land a rocket, or something like that, a new fundamental concept of engineering, of technology, of science, you will have to iterate to get it right. There's no way you can't. There's no such thing as a one shot, one formula, one academic paper, and then that's it. It just doesn't work like that. It requires a lot of knowledge and then lots and lots of iteration. Any kind of science, any kind of technology, any kind of engineering is Popperian in that sense. There's no truth, or to use another concept from mathematics, it's like a zero knowledge proof. We don't know what the underlying knowledge really is, but what we have is certain ingredients. We have certain basic knowledge, or what Elon Musk calls first principles. And then we start from there, we iterate until we get to the point where it works. That's how Elon Musk built the Model S, the Model Y, the Model X, the Model 3. That's how he's trying to do autonomy. I think he will succeed because the concept is the same. Low-cost hardware, low-cost software, lots of iteration, low-cost engineers, everything low-cost because you can't afford to spend a lot of time on intelligent people, on intelligent hardware, etc., etc. You solve everything by just iterating, and in order to do that, you have to have low cost or a lot of capital. The other way around. I mean, cost is always defined as the amount of capital you have available. So you can have higher cost iteration if you have more capital available, and the other way around. So I think what Hugh Henry and the traditional hedge fund managers that are still in business do today, they're trying to do the iteration. Here's the difference. They are doing the iteration. So they think that they can iterate. And what we're doing is we're saying, no, we're just going to find somebody like Elon Musk in the operational space. So we are in the finance space, and then there's the operation space. And what we're saying is, look, wealth is generated through iteration, adaptation. The only difference between us and those other hedge fund managers is that we don't think that we actually have the ability to iterate, particularly not around the real world. It's where the feedback mechanisms are way too slow, and the chance for us to be right is just impossible. So the feedback mechanism within an operation, for example, the feedback mechanism within Tesla is much faster. So I'm much better off putting my money into a company that iterates and generates the wealth than me trying to iterate around companies. This is the fundamental difference. I think that's why in the long term we will have much higher returns than anybody. We're right now around 20% CAGR for over 12 years, which puts us probably in the top 1% of hedge funds that have been around since 2008 when we started. We aim to get even higher than that. We think we can be in the top, if not the best hedge fund in the world, as measured by cumulative average annual return after fees. That's the measurement. That's the threshold. So I don't care about other things. I don't care about how much capital do I have, how many people do I know on Wall Street, how many enemies do I have on Wall Street, how many tweets. None of that stuff. All I care about is cumulative average annual return. In other words, if you put $100 with me at my inception, how much are you going to have after X years? And the higher that number is, the more successful I am. And I can beat that by, I need iteration for that, but I'm not doing the iteration. Actually, I'm trying to iterate as little as possible. I spend a lot of time thinking about where to put the money. And once that process is closed, the money is put, then I hope I have to never change. Now, we do change because sometimes we're wrong. That's the problem. We could be wrong. And the difference with me and Hugh Henry is because my attitude is let them iterate. So I give them some time, and I by definition spend a couple of years looking at the iteration process, or in other words, at the disruption, because again, the disruption and iteration are the same thing, just from a different perspective. You can't disrupt without iteration, and you will not get to building out an innovation stack if you don't iterate by definition. Other things in our principal stack, for example, the 0 to 1 concept by Peter Thiel, it doesn't specifically talk about iteration. It talks more about uniqueness, talks more about really trying to think about the impossible and along those lines. But that's an important ingredient into it. Why would I iterate into something that is possible? Well, why would I iterate? Why would I try to make a car that is like Volkswagen? I mean, well, what's there to iterate? I just copy them. And that's how most businesses are. So Thiel is saying, be different, iterate, etc. In the first episode of today, I spoke about the concept of the reality distortion field. It's another concept, excuse me, that I find very interesting, and I spoke about this morning. You see, most people look at reality distortion field in a negative way. They say, you are delusional, you're crazy. In Silicon Valley, some of the most prominent VCs, such as Ben Horowitz, they would say, no, this is the definition of an entrepreneur. If you don't have the reality distortion field, you're not an entrepreneur. Now, that's not the only thing. Of course, you need the other thing, and the other thing is, okay, this is your reality distortion field or your goal. Now tell me how you're going to iterate. How are you going to get from here to there? I don't care about the actual, there is no linear knowledge here, but tell me how you're going to iterate. What's the cost of iteration? And that's the conversation that leading VCs have with people that like Elon Musk or Larry Page and those real big wealth creators. Lastly, I want to talk about, this is now a little bit scientific, but I think it's interesting. Stephen Wolfram has his new project called The New Physics, or The Other Physics, which builds on a book that he wrote, A New Kind of Science. And Wolfram is very controversial, and I don't want to go into that conversation, but all I have to say is he's one of the most interesting people in the world, period. And the reason it's so interesting is because he thinks very, very differently. But he thinks about things that actually everybody else agrees with. He just looks at it from a different perspective. Here's what he's saying. He's saying, look, science is trying to take data and create a closed-end formula to understand what the data means. He's saying that works for some things, but there is what he calls computational irreducibility. Some things you just can't put in a formula. So how else can we then progress? Well, we can do it by iteration. He's not using that word, but we can just try and we can try to create a model which starts somewhere, and then we have a simple computation for whatever that is. I think this is still part of research, but what kind of computation is it? But we have a simple transformation of point A into point B, and then point B into point C. and that is the computation. And that simple transformation, if you iterate over many iterations, you get to a very complex system. And the question is, what kind of computation is that computation? Is there something like a fundamental computation, maybe, that the whole world is built upon? And if so, what is it? And so on and so forth. What's interesting here is not I'm not a computation researcher, nor am I a fundamental physics researcher. What interests me here is just the thought process. So, and this brings me back to the beginning. I am not a manager of time, because here's what I'm saying, and this is very deep now. So we have this concept of the other physics by Stefan Wolfram, which, by the way, we also have general relativity and space-time. So we're in a point A, and there's some point X somewhere out there, a bunch of iterations from here, and that point X is where we're trying to get with our fund, because that point X is wealth generation. So we're here, and there's a point X, for example, there's Tesla with a full self-driving suite, $5 trillion market cap, fully electric vehicle fleet, and the world is 50%, if not 80% electric vehicles, and Tesla has 30% market share. How will we get from here to there? We at Orange Capital Partners, we're not managing time. We don't care about those iterations. We don't care about or what Stefan Wolfram calls the clock speed, and how many iterations do we have per day or per second or per millisecond. It's irrelevant. We're trying to look at space-time today and try and assess, look, this is what it is. This company is going to get there, and we're going to invest. And the only thing we monitor as investors is, do they continue to iterate? Number one. Number two, is there any kind of feedback loop that we can say what they're doing makes sense? So there is a chance that we're right about them already being at point X, even though it's not, of course, it will take a lot more iterations, but as far as we're concerned, they're already there. This is what gives us all this confidence that we invest so much money, 80% of our capital in Tesla. It's because we have so much confidence that this is where the company is going to get. Now, there's, of course, a lot of possible, the company could blow up, and there could be bad things, and they could be, Elon Musk could get killed or whatever. There's a lot of crazy things that could happen. But within the realm of whatever we're comfortable with, we think that all these iterations, or the time that it takes from A to X, for us is irrelevant. As long as they keep iterating, as long as the feedback loop of iterations is to our satisfaction, and there are certain things we look at, like our principal stack, like I said, is part of the most important thing, then we're comfortable. And I think what people like pretty much anybody else, including Hugh Henry, they still think of time as some sort of continuous thing, that we don't know what the future will look like, and we have to continuously adapt and change our behavior because we're wrong. We're wrong a lot of times. So they don't look through all these iterations. They try to iterate themselves whenever the information is available to them. And this is, in my view, it's a futile process, because, to use Stefan Wolfram's word, the computational irreducibility, you just don't know. You're like a leaf in the wind. If you do that, you lose your senses, you lose your passion for the business. If you do that, it's fun in the beginning. It's particularly fun if you ride a few times, but this is the proverbial coin toss game. You just keep tossing the coin, and you ride a few times, and it feels great, and then you fall on your nose. Instead, what we're doing is we're looking through space-time. We're looking through all this iteration, and we say, look, this company is going to go from A to X. And the only way they're going to get there is through iteration. And the only thing we can say today is, number one, how costly is that iteration? What are the first principles that the iteration is based on? Maybe it's wrong. Maybe it shouldn't be like that. But if we're comfortable with this, then let them iterate. Let them just do it. And it's kind of like a zero knowledge proof. We don't need to know exactly why it works. As long as they keep iterating, as long as we're okay with the game, as long as we feel that our thesis is in line with what the iterating the feedback loop gives us, we're okay with that. And this is the fundamental difference between us and all the, I call it, traditional hedge funds. We trade less, we don't iterate, we let the companies iterate that we invest in. So we look for companies that do the iteration, the adaptation. We ourselves don't do it, because the feedback loop between us and the companies would be too long. To be clear, it's the feedback loop between us in finance space and the companies in operation space. The companies within operation space, the feedback loop is much faster. They have a much better chance to iterate and win versus us iterating around the operation space. Having said that, just one last caveat here. Of course, there are hedge funds that are saying we don't care about the operation space. We only care about finance space. And that's, my head's off to that. There is a possibility people like Paul Simmons, the algo traders, they live in finance space. They don't care about that. For them, companies are just numbers, zeros and ones, and they use that to make money in the finance space. That's fine. We're not in that business. We're trying to make money with operation space. In other words, we're betting on entrepreneurs and wealth generators, and the feedback loop between them and us is way too long. So that's why we're not iterating. We're letting them iterate. Thanks.